All right, this is the week. I have to do it. I have to go bearish on the stock market. The signals are just piling up. I can't continue to ignore them. I know that momentum has been so strong on the indices, the S&P 500 and the NASDAQ, and that's why I've been holding back, because momentum is powerful and no one should stand in front of that kind of thing, but I have to go there. And you're going to have to hear out my case. I have a lot of different things to go through. So just hear me out. And of course, I'm very interested to hear your comments, and particularly anyone who disagrees or has a counterpoint. All right, starting off with the IPOs. Cerebrus came out yesterday, May 14th, and I think it almost doubled or more than doubled from its IPO price, somewhere around there, and then faded straight down. Okay, so a lot of people holding the bag on that IPO opening, and it fell another 10% today. That is one warning sign, because this was a big, much anticipated tech IPO, and it's essentially doing terribly right from the gate. Not from the IPO price, of course. Anyone who got in at the IPO price is still making plenty of money. But those people who decided to get in after it started publicly trading, very terrible, very bad. And then I see a headline today that SpaceX is considering accelerating the timing of its IPO. Now, it's very curious, right? Coming after Cerebrus, they must see the writing on the wall. The getting is as good as it's going to get right now. The market still doesn't care about anything. It doesn't see a concern or care in the world. This is the time to IPO your company when it's already at a very high valuation, and SpaceX probably sees that. That's just my guess right now. And, they probably also want to participate in getting a very inflated price, right? They have a lot of funding needs that are going to be, very big. So anyway, that's just on the stock side. Now let's go through some fundamentals here. Okay, first of all, the bond market, stock market. Again, it's in this we don't give a care mode, but the bond market does care, and the yields across the globe in major industrial economies have been going up and up and up and up. I think I heard Japan's JJBs are at 30-year highs. The UK gilts also reached 30-year highs. The bond market sees trouble. And what is some of that trouble? The trouble is all these governments have huge debt loads, and inflation is creeping up and up and up and up. The inflationary pressures have been creeping up. Again, the market hasn't cared one bit about these inflationary pressures, and I guess has chosen to listen to the folks that are saying, it's just transitory, just temporary, it'll go away, it's no problem. Meanwhile, the average consumer is actually having a lot of problems, and I won't get into that part of it yet right now. So anyway, the bond market's paying attention. The stock market is not. The stock market, you and me, people in the stock market, we need to be paying attention to what the bond market is saying and telling us. All right, this week we also had the China and U.S. summit, much anticipated. It was delayed, of course, by the start of the war against Iran. I don't know. I'd be interested to see hear what you think, but the summit seemed anticlimactic to me. I didn't see any really big announcements. Sure, they're buying 200 Boeing planes, okay, whatever. But we didn't see any big celebrated announcements. But I think on the good side is coming out of that summit, we didn't hear about any big insults or arguments or threats to do this or that if you don't do this and that. So that part to me is good. But overall, very anticlimactic. Not a lot accomplished in terms of fundamentally changing the animosity between China and the US. And in fact, no sooner did the summit end, I saw a headline where China is insisting that the US get the Strait of Hormuz open and negotiate a ceasefire with Iran. I don't know about you, but I've been hearing for weeks that both things are already in place. The Strait is open and there's a ceasefire. In fact, remember, back in April, what started us on this extreme upside, this 45-degree angle move in the major indices, the NASDAQ and S&P 500, was the announcement of a ceasefire. And since then, we've been hearing there's a ceasefire, but the action and the results on the ground keep telling us there is no real ceasefire going on. But again, the stock market hasn't cared about a thing, and the stock market hasn't cared. They're just focused on that one announcement and pretty much blinders straight ahead. All right. Now, oil, as a result, is still very elevated and is at basically at the highs that it's been throughout this conflict in the Middle East. Now, after saying all of that bearish stuff, market breadth, and this will be one of the first things we take a look at when I get into the charts. Market breadth looks very bad. It hit yet another low in the cycle. I had a short earlier talking about it. I'm going to have to get into it again because market breadth is screaming bearish at this point. And like I said, I just cannot ignore all of these signals now. Now, mind you, when I say I'm bearish on the stock market, I'm not saying sell everything. I'm saying this is, for me, a time to do risk management. I want to lock in profits on positions that I think have run well ahead of what I ever expected it could do. And then I want to dump overboard positions that have been performing poorly because those stocks are going to get absolutely crushed if the market truly is topping out. So again, just as a reminder, I'm not saying when I'm bearish on the stock market, I never say sell everything because I know that over the longer term, the stock market in general as an index is going to go higher, right? So panic just does not get rewarded in this kind of environment. Anyway, another thing that's probably going to keep things together, at least for the next few days, is NVIDIA's reporting earnings next week or in the coming week. I'm guessing that the market will still cling to some modicum of anticipation that NVIDIA will have great news to recharge the semiconductor play and the AI play in general, but we'll have to see what happens there. All right, that's enough of the intro. Hopefully, if you have some counterpoints, I just would love to hear it because I would love for any reason to back off of my short-term bearish trading call. All right, let's get into those charts. This is my favorite technical indicator, the percent of stocks trading above their 50-day moving averages, what I like to call AT54 above the 50. Let's review the bearish case once again. 70% threshold defines overbought. You can see here back in January, February, late January, we had the double fade from that level, and market breadth just continued to tank right through the Iran war and almost bottom right at the oversold threshold. Look where market breadth is now. Again, we had a double fade. It was after just, 2 out of the 3 days, actually all 3 days technically, a fade from the 70% overbought level, and market breadth has not been the same since. There was this attempted rebound right in this area, and now it's at a new low. Now I put a horizontal purple line in here. This is now it's closed at 49.74%, which means that 50-50 stocks above or below the 50-day moving average. And you can see, if you follow this line along, this is a very important milestone marker, right? This is right where market breadth first surged when we heard the news of the ceasefire. This was back on April 8th. And then if I follow it back further, you can see it was kind of a pivot, right? 50% is kind of important. I'm surprised that the indices aren't worse with the market breadth down here, but you can see what happened last time back in February when this line was breached and it closed below, it was straight down again from there. And I'm afraid that that's what's in store for market breadth again right now. All right, let's look at AT200, which is the percent of stocks trading above their 200-day moving averages. And you can see it's now finally broken down. It's almost reaching this box that I way back several weeks ago, I said I did not want to see AT200 get back into this box because it would signify a return to a bearish signal. I'm just calling it. It's essentially there, right? If you look at this line, AT200 closed at around 50.5%, and it's right above this box level. So I'm just calling it close enough to be concerned. Now, what is the impact on the indices, or what are the indices telling us? Well, let's take a look. This is the S&P 500. It hit an all-time high on Thursday, and check this out. It gapped lower, right, and lost 1.2%. So the loss is not that big a deal, but This gap lower leaves behind what's sometimes called an abandoned baby top, a Gilligan's Island, something like that. But essentially, anyone who bought on Thursday is immediately trapped with a loss. That creates selling pressure because at some point, if the S&P 500 continues to go down, it's going to create more and more pressure for people to take their losses. But overall, you can see that from a technical standpoint, there really is no problem with the index because its uptrends are so strong. It's still far above its 20-day moving average, which is that dash line. Still far above its 50-day moving average, which is the red line, and even further above its 200-day moving average, which is the blue line. Now, of course, bears will say that the distance from those moving averages is far overextended, and I agree. It's just that the market has been so bullish, so strong that these distances haven't mattered, but they will matter when they do matter, as the saying adage goes. And when things start to come apart, I'm expecting S&P 500 to fall to these moving average supports relatively quickly. And again, I want to sort of at least be mentally prepared ahead of that happening. Now, the NASDAQ, which has been, of course, leading the whole market, it managed not to close at its lows. Unlike the S&P 500, there was a little bit of buying interest at the lows of the day, but it still lost 1.5%. It still left behind and trapped all the buyers from Thursday. So now there's a bull trap on the S&P 500 and the NASDAQ. And you could see the trading volume starting to increase here as well. Okay, and the same problem with the NASDAQ. It's far above all of its major moving averages, which makes it in dangerous territory. Actually, let me change that all-time high. That is up there. All right. Now, IWM, the ETF of small caps, it topped out already ahead of the major indices. So it is now lagging, and it's now the first to fall below the 20-day moving average. It fell and lost 2.4%. That's a pretty big loss, and you can see the jump in volume here. That's down here. Actually, let me just draw an arrow so I can be very clear what I'm talking about. It's right there. See that jump? Again, as regular viewers know, I have this regular trade I do of call options. I made a big mistake earlier in the week. I had a chance to get out of my last trade with a profit, but I got greedy and held on. I even added to the position. Just big mistake. I lost discipline there. And today I did one last trade, same trade, calendar call spread, but this was before I really put all the pieces together to get bearish on the stock market. If I had been bearish, if I had made the bearish call earlier, like during the trading day, I would not have done the IWM trade again, but it is what it is. So those are the indices. They're all they're coming apart. Now, the volatility index gives me the final bit of confirmation here. As I've been pointing out, this pre-tariff low in the VIX, that's right here, this horizontal purple line, has been holding up strong and suggesting that the VIX is not going to go any lower, that there is this undercurrent of fear in the market that's just waiting for an outlet, waiting for an excuse to burst higher. And we had two of those bursts. One was at Monday, and then the VIX floated downward the rest of the week, and now it popped again. It actually faded from a high of 19.3%. So, bulls can take some solace in the fact that the volatility faded after that. But anyway, the VIX is telling me it is ready to erupt again. Who knows how high it can go, but that's the next piece of confirmation. All right, I talked about government bond yields going up. TLT is the U.S. equivalent of the 20-year Treasury bond. It's also sort of a proxy of the 30-year. Big drop today, Friday, 1.48%. Let me just peel back so you can see just how bad this is. TLT, I believe, yes, hasn't been this low since way back in 2023, and it hit a bottom there. So, again, if you're bullish, you're going to say, well, it's not going to drop any further. It's testing support, and it'll be bound to rebound. Well, I do recognize that when bond yields get this high, the government, and particularly the US government, gets nervous and starts to try to do things to get bond yields back down. And there's a huge motivation to do so, specifically because debt is so high and so much of our debt is in short-term paper that the cost of these high yields is tremendous because the government has to refinance. So this is something to watch. Like I said, we stock investors and traders have been ignoring the bond market for this entire rally that's continued through May. It's time to pay attention. Now, these higher interest rates, like I said, inflation pressures are part of it. They've also helped to tank commodities. So silver, this is ticker symbol SLV, the iShares Silver Trust. It gapped down big time, 8.6%. Threw off the previous trade I had in silver was a call spread 80.90 that expired today, worthless. I put on another one again before I was really connecting all the dots. So I'm not too confident about this latest one. I think I did a 70.80 call spread expiring in June. So again, if the government does start to do things to try to get those bond yields down, I expect silver to just shoot right back up. Also on the commodity side, I like to use BHP on the NASDAQ, not on the Australian index. BHP Group Limited as my proxy for pretty much all commodities because it's a very diversified commodity player. It gapped down because yields have been soaring so much. It gapped down 5.1%. That's a pretty big move for BHP. I am long. I'm going to stay long. And the uptrend, of course, is still there. And I also think over the coming months, the uptrend should stay there. I did try to get cute earlier with my commodity plays, but I'm done being cute. I just want to just hang in there for the longer term. All right. So consumer-facing stocks are one of those areas where the signals are have been some time. And now, again, it's time to pay attention to them. Let's take a look. TJ Maxx, I did a short on that earlier. And you can see that it has now broken down below its 200-day moving average, and it is bearish. It's officially bearish now, unfortunately. It is struggling to hang in there, so it hasn't confirmed the breakdown, but this is pretty significant. It fell 2.2% below the 200-day moving average. It seems like it's almost a matter of time before it drops below the 2026 intraday low. All right, now there's some more convincing bearish consumer plays. Here's Wingstop, ticker symbol WING. I'm just going to show you the consistent selling. This was a fake rebound in April where Wing kind of rode the coattails of the general market. Notice it did not have any coattails to cling to in May. The volume is picking up. This to me is another sign, particularly given Wingstop has a high amount of short interest, is another sign that people are trying to get out of the way of a big impact that's coming on consumers that will then cascade throughout the market. Abercrombie and Fitch, I talked about this one before, ticker symbol ANF. It broke down last month below the 500 and 200-day moving average and looks headed straight for the lows from last year. And if it doesn't hold those, then there is a lot of air under here to keep falling all the way back to levels last seen in 2023. So Abercrombie and Fitch, another red flag. Okay, BIRK, ticker symbol BIRK, Birkenstock Holding. It reported earnings last week. It was pretty disastrous, lost 12.9%. And, Birkenstock was one of those hot IPOs. It was really trendy and sexy to talk about. It peaked in 2024, has not been the same since, been downtrending, and now it's smashed itself into all-time lows. That's another warning. So we have the chic retail stocks not able to hold up. Dollar Tree is flashing red. Here's the Head and Shoulders top that I pointed out before. It broke down below the neckline here. And you can see the only thing that held it up, it seemed this week, were the lows from last September, October or so. But it's been bearish ever since it broke down below the 200-day moving average, which is the blue line. Dollar General also gave up the ghost recently, and you can see it too looks headed for recent lows. Now on the flip side, we have ticker symbol CASY. This is Casey's General Stores, and it has been on an incredible run for many years. In fact, let me pull this all the way back. It broke out, let's just call it in 2019. It had a bump in the road during the pandemic, of course, and it has almost been straight up ever since. You can see that it's starting to peel parabolic a little bit. So it's time for it to cool off. Maybe it falls back to the 50-day moving average as consumer stocks continue to crumble apart. All right. Also, consumer facing are home builders. Of course, I'm really big on home builders. I follow them and write about them a lot. ITB has had a terrible, terrible month that started with a peak in April. Home builders rode the momentum with the rest of the stock market. It shouldn't have, because bond yields had been going up and up and up and up. And finally, home builders gave in. Bond yields just got too high. Mortgage rates got too high, and sellers have been active almost the entire month. ITB now is not only below its bear market line, which is that purple line there, but it fell down to levels last seen, yes, last seen at the lows of 2025. And some of the implications of this are some stocks, of course, in the index doing even worse. So KB Home, which I wrote about it, commented on its earnings. This is ticker symbol KBH. I wrote about it in Seeking Alpha, and it looked like a bad call because, again, home builders just rode the market momentum higher in April, but now that party has come to a very quick end. The stock has collapsed and it's back to selling off as I expected. KBH is one of the worst in the ITB in ETF, and so this stock is trading at levels last seen November 2023, and it looks like it's going to test that low. So home builders are falling apart. This is an even more important indicator in terms of the whole consumer facing field of stocks. All right, let's go to software. The SaaS apocalypse, the AI panic. I talk a lot about it, so I'm not going to spend a whole bunch of time here, but I did want to point it out because it looks like there was a lot of money that moved out of the hot stocks, didn't go into consumer, maybe a few consumer names, but did go into the beaten up software sector. So the software sector is still looking like a bearish to bullish reversal. This is ticker symbol IGV, iShares Expanded Tech Software Sector ETF. And you can see here that it was up 1.3% to a new high for this cycle. It's up to, let's just call it a near 3-month, 3.5, 4-month high. That's very bullish for the thesis that I've had, and I've talked about it enough and written about it enough that this thing is reversing, and at its lows, it was way overdone. This move is proving that out. Now, on the flip side, we have IBM, International Business Machines Corporation, which hit a new low for the year and a new, let's just call it a new roughly 52-week low. I do have a small amount of shares in IBM. I'm not going to add until the technicals get a little bit more bullish, but I am concerned that this IBM weakness is an early sign of a pending reversal in IGV. Also, a little bit of concern is Blue Owl Capital, ticker symbol OWL. I've talked about this also enough. It's still in a bearish to bullish reversal because it's above the 50-day moving average, but it's getting very close and precarious. It fell 3.6% today, even on a day when software has been going up, right? So remember, OWL is connected to the prospects of software because of all the lending that they've done into the sector. So I would have expected a tighter correlation. And instead, it's been an inverse correlation the last week or two. Very surprising, very bewildering and confounding. All right, let's go to, actually not FIGs, let's go to FIG, ticker symbol FIG. This is Figma. Wanted to point this one out. I do have a small position because look at this. The volume has just surged like crazy. Look at these two lines here on Friday and on Thursday. And what happened was earnings, and FIG soared today 13.2%. It closed above, actually it's kind of hard to see, it closed nearly above the 50-day moving average. It hasn't done that, hasn't closed above since February, March, end of February, but this is a very clean breakout. If I didn't already have a position, I would be buying here with a stop below the 50-day moving average, which happens to coincide, let's just make this clear, coincide with the intraday low. So this is telling me that FIG is ready to go on a run, but I think it's going to be hard for it to continue a run if indeed the market does sell off. But I am watching it because I do have a small position in it. Now let's talk AI related positions, and the only one I need to show here is DRAM. It's a new ETF, ticker symbol DRAM. It's the Round Hill Memory ETF. This is going to be a great proxy for the stocks that the market has been in a total mania about. These are the memory stocks like Micron, SanDisk, and others. I think it's also an international one, and you can see here a blow off top. Actually, let me make it clear. This is a blow off top here. And why is it a blow off top? Because going into that day, there was a huge move 13.4%, gap higher, and then a gap down after that, a 6.9% loss. Now, let me just move that circle out of there, and you can see that that blow-off top was almost invalidated until the losses started again on Thursday and Friday. So I consider this blow-off top still in effect, even though some of the individual stocks in the index are not quite as clear with the blow-off top. But if this is a blow-off top, it's going to start a cascade at some point, with NVIDIA being maybe the last thing standing between a recovery and continued selling in the sector. So keep an eye on DRAM, ticker symbol DRAM. Now let's go into a few other stocks. These are various holdings of mine. Or stocks I wish I held, just to review them. Intuitive Surgical, ticker symbol ISRG, has been a disappointment since jumping 7.2% post earnings last month. It has been selling off. It is now below. Oh, wow. Yeah, look at this. It's gone down to prices last seen in the summer of 2024. I'm very worried because, as you can see, it's possible that ISurge, as I keep saying ISurge, ticker symbol ISRG, this is Intuitive Surgical, is making a double top. And let me just draw it out here to be clear. Here is the first top, right? And here is the second. And if Intuitive Surgical trades any lower, in fact, technically it's already confirmed the double top. If it trades any lower, I may have to get out of it. This will be my second time stopping out and just leave this stock alone until such time. Maybe I get a much better discount, much better risk reward entry. All right, Zoom Communications has been interesting. It is still in this very subtle, slow, bearish to bullish reversal, but it has not been traded, and it's not traded consistently. It's been very choppy. I got stopped out of my last position. I really wish I hadn't, because I wanted to just keep riding Zoom Communications, ticker symbol ZM. And I finally got a chance to get back in. It sold off sharply for 4 straight days, stopped cold at 20-day moving average support. That's this dashed line as a reminder. And so far, so good. Even though Zoom did fade from its highs, I'm hoping there's some good news on the other end of this huge run up, and that this, stock has been going up like this for a reason, but it's been very hard to call. But I do think at some point, Zoom is going to go on at least one more epic run. All right, First Solar, strangely enough, it is back into bullish position. Not sure why. I don't know what conditions changed. It did report earnings. The market has interpreted that positively, but you can see here it is now broken out above the 200-day moving average. It confirmed the breakout with a higher close there, so it's back in bullish form. The only thing that stopped me from buying it today was the fact that I just am suspicious. And now that I'm bearish on the market, I'm even more slow to buy into this. But it's now back on the front of my radar. All right, trucking. I don't have time to go into all the trucking and shipping stocks, but CH Robinson Worldwide, ticker symbol CHRW, is one of my go-to. And it has been hit several times now, and it looks like it's starting to roll over. I've talked about this plenty before. This big drop here, actually, let me do the arrow again. This big drop here was from a AI company that claimed to have some disruptive technology. You could see it recovered, but it didn't recover all of its losses. So that's very concerning, right? And then it got slammed again with this announcement from Amazon about its supply chain services. It recovered, but not all of the losses. And then it started to fall back again, right below 50-day moving average resistance. You see the constant selling, and then there's a Supreme Court ruling that basically opens up a greater field of liability, a wider berth of liability from state lawsuits against truckers. So they're being held liable for the drivers, even when they're contractors. I believe that's the nature of it. Don't quote me on that. But anyway, clearly it really hit the stock hard. It came back down to support from the post-October earnings closing low, but then it bounced again. But if the past pattern holds up, this also may not hold up in terms of CHRW being able to continue to rally, and that's got me worried. And then let me just end up. I was talking about the AI play. I shouldn't ignore this one. Cisco, it's holding up strong. This is also a positive sign that runs counter to my worries about a top. Cisco, ticker symbol CSCO, soared 13.4% post earnings. And look at this. Even though the day was weak, Cisco somehow managed to gain 2.3% for a new all-time high. So maybe Cisco will be the big tell for AI and not DRAM and not NVIDIA. All right. Thanks for hanging in there. As always, subscribe to this channel if you like the content. You can put comments and feedback down below, and I will respond very quickly. And of course, please like and share the content so that the algorithm knows what's up. Once again, this is Dr. Dewar from Ahan Analytics with the Market Breadth. Thank you for checking this out. Take care. And remember, bearish doesn't mean sell everything. It means risk management has become even more of a premium now. All right.